Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors. January 12th with the Moose, John Mousseau, our CEO, Director of Fixed Income. First couple of weeks in the books, Moose, when I look over at equities and commodities, kind of a trading range. Fill us in on fixed income.
Yeah, pretty good week. A grind down in yields. 10-year bond started the year at a 388. We know we gave up some last week. This week went basically from a 405 to a 395. 2-year notes down even more. A lot of this all driven today, though, by something we don't talk about too often, and that's the producer price index. And that came out today.
And what is that?
And that is the prices paid by producers. So not the
the end user.
Right, not the price of cereal, the price of the inputs into the cereal. That was negative. And the core was 0. So it tells you that eventually shows up in consumer prices. It's a very good sign. It's an irregular relationship, but pretty positive related. And so the markets took solace on that, and bonds are up today after yesterday's CPI number, which was okay, but maybe a tenth disappointing. But I think what it says to people is inflation continues to ratchet down. The Fed will eventually cut rates. Not a question of if, but it is a question of when.
Gotcha. That seems to be the consensus, which we always have to be careful about.
Sure.
In terms of, say, the benchmark 10-year Treasury, where are you comfortable with that trading?
It's 4% is a good number, right? Because you got as high as a little over 5. We know that we went all the way down to a 388, which is exactly where we started last year and we finished last year, except it was a hell of a ride in between.
Right.
And where we are now, it's pretty solid. And it's really good is if inflation continues to ratchet down. And we know that the headline inflation number is in the 3s. If it gets into the 2s, then you have a pretty decent positive spread to the 10-year. So I'm pretty comfortable with it here. I actually would like to see it kind of hang around here, and we can collect the coupon for a while.
Sure. Okay. Equity-wise and commodity-wise, I mentioned, we've been in a trading range. What I thought we would do today is take a look at a couple of charts. I find them interesting. More importantly, they're trying to give you some details on terminology and talking head headlines that you hear every day. The first chart is the next 12-month PE ratio of different styles on the equity side: growth, value, equal weight, cap weight, value. So what I wanted to draw your attention to, and I circled them, is growth is trading well above its 10-year average forward-looking PE. Right? So when you get up there in the 26 area, maybe that's a concern to people. We hear that every day. We just like to be aware. Does that mean at that rate we just sell? No. When we look down at the bottom half of the chart, you can see that the S&P 400, that's mid caps, and 600, small caps, well below their 10-year forward ratio.
Right. They've been left behind a little bit.
They've been left behind. So we want to be aware of that. Is there a trade there? We do. We're long in both of those scenarios. We're long growth. We're long value in the small and the mid. We just want to be aware. Positioning. Now, the second chart I want to share with you gives some reasoning why growth is trading at a 26-time forward number.
Right.
Because I get tired, to tell you the truth, of listening to people talk about how expensive the Magnificent Seven are and how that's all there is in the market.
It gets old.
It gets old because without giving context, John, that kind of commentary can almost be misleading.
Sure.
So the second chart is giving you the net margins, which net margins are after calculating for all expenses.
Right.
I find them very accurate.
Yeah.
So the Magnificent Seven net margin rate, let's call it 20% the trailing 12 months.
Right.
The other 493 companies in the S&P 500, 10.
Wow.
That's a 2x net profit margin difference.
Right.
I won't bring up a third chart showing the earnings growth
Right.
of the last 12 months, of the Magnificent Seven, which, just to review, Apple, Microsoft, Google, Amazon, and so on, NVIDIA. As we finished December, Q4, the earnings growth rate for 2023 was 4x the other 493 companies.
Left behind.
Now, I'm not saying you need to trade at a 26 forward multiple, but let's not be so lazy that we just circle that number and say, hey, these companies are so expensive, you've got to get out of them, or it's going to be a crash, or it's going to be...
And lots of well-known long-term companies in there.
Yeah, in the other... Yeah. So there's always reasons for where securities are priced.
Right.
Securities do not price in a vacuum. People come up with ideas of where securities should be priced. It tends to be the price is the price.
Right.
And you make your determination if that's reasonable or not for you. So ideally, we'd like to see a little bump in small and mid. We got it in Q4. Sure. Let's see it continue. Took a little time off these last few sessions.
Right.
Growth kind of kicked back in. But one thing we know, we'll have some volatility this year. And the one thing we repeat consistently with clients, do not confuse volatility with risk.
Exactly.
Two different things. Thank you for joining us. Remember, on Monday, Martin Luther King Day, markets are closed. We will be back with you Friday. Enjoy the weekend.